stock prices change every single transaction. Every single trade will adjust the price of the stock, and it can be just by a couple pennies. But what happens is when you look at price changes, daily price changes, during the course of one day or even like day to day, it jumps all over the place. And so you get these lines that are, you know, like, you can't really see the trends because they're too jagged. And what the smoothing technique does is it takes these individual price fluctuation numbers and turns it into a pattern. So it allows us to see the trend in the jagged lines. Does that make sense? So, I mean, that's literally, it's smoothing out the jaggedness. And there's a couple different methods for this. Okay, so one of the main smoothing techniques that gets used is what's called a simple moving average. And they can be different sets of time. You can have a 3-day, a 5-day, a 10-day, a 1 week, a 1 month moving average. And you take the average of the stock price over that period of time. So you take the 3-day average and you keep shifting it. So you take the first 3 days and then you shift 1 day over. You take the next 3 days, the next 3 days, the next 3 days, and it gives you a smoother line. The technical definition says it uses the arithmetic mean, but that's just an average. So if you see the word arithmetic mean, that just means to take the average. Now, these are lagging indicators, okay? Lagging indicators are, in statistics, any historical data. So you're using past data to try to predict future or current events, but it would be impossible to smooth current data. You can't keep up with it, and it's just, you don't have time, you know, it's not, you can't do that. So you go like a month or 2 or 3 back, smooth the data to see the trends. And that's called a lagging indicator. And all smoothing techniques are lagging indicators, and all stock market decisions are made on lagging indicators, because even if you're watching the stock price change during the course of a day, the decision you're making is based on the transaction that already happened, the price that already changed. Does that make sense? You can't predict 100% accuracy what the new price is going to be. You can only base it off what the last price was for the last trade. This SMA tells me it's a simple moving average, and then this tells me how big of a block of days I need to do at a time. Okay. So okay.
So you add up the current price of those days?
Yeah, what we do is we take, so we're going to look at these 10 days and we're going to do a 5-day moving average on it. So here's what happens. I'm going to use color and hopefully not run out of space. We're going to find the average of the first 5 days. That's average 1. Then we're going to find the average of the second 5 days. Then we find the average of the next 5 days. And then the next 5 days.
Would this be one question?
Yes, one question. The next 5 days, and then finally the last 5 days. So for our 10 days, we're going to end up with 1, 2, 3, 4, 5, 6 sets of data. So I'm going to start with our first 5 days, which was pink. Okay. So I'm going to take those first 5 days and add them up. And then because I added 5 days, I divide by 5. And that gives me 35.22. Then my next set was green, but I'm going to use a different green because that green is not going to show up very well. So now I'm going to take the next 5 days. So what I've done is I've just shifted 1 day over. I divide by 5, and this one's going to give me 35.31. Okay. Then the next 5 days, divided by 5, and that's going to give me 35.32. Then I take the next 5 days. So like I said, it's time consuming, as you can see. And then we have 2 more. The next 5 days, and then the last. Okay, why did we do this? From here to here we went down, down, up, down, up, down, up, up, down. So if we were to graph these, it'd be jagged. But by doing the averages, look at what happens. Up, 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 up. Even though we're going up, down, up, down, up, down, up, down, up, down like that, our trend is actually that this stock is increasing. And the smoothing technique, this average, allowed us to see that. That's why we do this. It gives us a better picture of what's actually happening because the real data, the daily data, is too all over the place to see the pattern in it.
They usually use 5 days or 3 days.
It depends. They typically use a 3, a 5, or a 10. Depending on what they're trying to, how smooth they're trying to go. The more you've smoothed it, so like the 10-day is not as accurate as the 3-day, but the 3-day is going to be a little bit jagged sometimes also. Does that make sense?
Why do you want to go up to 6?
Because it's always 5 groups of 5, and this is our last group of 5. So if I went to 7, I'd only have 4 at that point, and it's not enough. If we were to plot the real-time data, it's not very pretty. It's hard to see the pattern, especially if you were going out more than 10 days. The simple moving average now, when you start plotting it, this number here is day 5, 6, 7, 8, 9, and 10. It's the last day of the first group. So this becomes day 5, 6, 7, 8, 9, and 10. Okay. So when we graph this, we start at day 5 with our first average, which is 35.22. Then we had 35.31, 35.32, 35.55, 35.74, and 35.89. I didn't quite graph that properly, but you can see the pattern much easier. So that's just like a picture of what it does. The way I did this originally is I kept adding the whole list every single time, right? You can use what's called the addition subtraction method, and you don't have to add everything up every single time. So here's what I do. I'm looking for the 4-day moving average. So that's not pretty. First 4 numbers, second 4, third 4, and fourth 4. So I'm going to have 4 groups of 4 on this one. So for my first group, what I'm going to do is I'm going to add all of these numbers together. And I get that 482. And I'm going to divide it by 4 to get 120.50. Now for my second, I'm going to take that 482. I'm going to subtract the first number and add the new number at the end. So I'm subtracting the first number, add new number at the end. So take that one out, put this one in. Does that make sense? And then I'll divide it by 4. So 42 minus 121 plus 124 is 485. Divide that by 4, and I get 121.25. And then I take this number, the 485 that I just found, and I subtract the next number in the list, 122. And I add the next number at the end, 128. Well, negative 122 and 128 is 6. So really I could just do 45 plus 6. Which then I divide by 4 to get 122.75. And then I take the 491 from the previous step. I subtract the next number on the list, which is 120. And then I add the last, the next number at the end, which is 126. So I'm adding 6 again. So that's going to be 497 divided by 4 You can take the two different time intervals of moving averages and you can put them on the same graph, and then you'll get what's called a crossover. And you have a fast and a slow interval. Your fast moving average is the shorter time interval. Okay, so smaller. And your slow moving average is the longer time interval. And it's relative to which one you're doing. So like if I do a 3 and a 5, the 3 is fast and the 5 is slow. But if I do a 5 and a 10, then the 5 becomes fast and the 10 is slow. Does that make sense? So it's between two different numbers, which one is fast and slow. And a crossover happens with, sorry, not with, when.
So the longer time interval, the longer number is slower.
Yeah, the longer number is slower. Okay, so you have crossovers. When you put the slow and the fast moving averages on the same graph, there will be points that they should cross. The lines will change, change places, cross over each other. When this happens, it signals the possibility of a stock reversal. Okay, now reversal is when, like, if the stock is going up, the reversal occurs when it starts to come down. Or when the stock is going down, the reversal occurs when it starts to come up.
Can you show an example of that?
Yes, I will. Okay, so here's the theory. There's a theory that the stock market people, analysts, that's not how you spell theory. Okay. If the fast moving overtakes the slow, so goes above it, you should buy. That is a signal that the price is going to start to go up. Because, right, the whole thing was stock, buy low, sell high. And if the slow moving overtakes the fast, then you should sell. Okay, so if the fast is below the slow and then it jumps above it, they say to buy. If the fast, or if the slow is below the fast and it jumps above, then you should sell. On this graph, you can't really see it very well, but there's like the little, this is the stock bar chart. This is the actual daily price things that are happening every day. There's, open and close and high and low. The green is a 5-day moving average. The black is a 10-day moving average. The fast one is the shorter time interval. So this one's the fast and this one's the slow. Okay. There are 3 crossovers on this graph. Okay. Now, I'm just going to go over here so we can have some blank paper. So we have the daily stock prices, the 5-day moving average, and the 10-day moving average over 60 days. Okay. What we have, the fast overtook the slow on August something. That's really hard to tell. Oh, hold on. 5th, 6th, 7th, 8th, 9th, 10th, 11th, 12th, 13th, 14th, 16th, 17th, 18th, August 18th. So on 8/18, fast overtakes slow. That's because the green line went above the black line. If you were an investor, you'd want to buy stock on 18th. And if we come back here, so we had the 18th, 19th, 20th, 21, 22, 23, 24. On the 24th, the slow overtakes the fast. On that day, you should sell. And then when we get back, so 24, 25, 6, 7, September 5th. Okay, I don't even know what day it is. So we'll just go with 5, 6, 7, 8, 9, 10, 11, 12. September 12th. The fast overtakes the slow again. And so you should buy. But if you look at the chart, you can see it is increasing here, but then it does go really low, but then it starts to come up high again. Like if you had bought here, it was $86 and change. Up here, it's now $89. So in this month, you'd have made $3 on each share of stock that you had. So it just tells you what to do. And if you were following this and you sold here before the prices tanked down here, you wouldn't have lost all that money. So that's what that helps you with. First of all, lots of stock information being published by lots of different entities. The most well known is the Dow Jones Industrial Average. You guys hear about the Dow all the time on the news and television, I'm sure. It tracks the daily trading action of only 30 corporations. But they use those, there are 30 major corporations, and they use those 30 corporations as kind of like the thermometer for the economic standing of the whole stock market, if that makes sense. Like if those corporations are doing bad, everybody's doing bad. Okay, Thomas Edison invented the first stock tracking machine. It was the universal stock ticker, and it printed 1 character per second. So if we, hold on, this is kind of, had to sit there and read the tape. Now, we've come a long way with technology, but the symbols have not changed. So now we have a digital tape, but it's the same symbols and everything. It used to be run by telegraph, and now it's billboards, computers, TV screens. And so we have some information on there, so we'll go over that real quick. The first piece of information on a stock market ticker is the stock symbol or ticker symbol. And we talked about if I incorporated Miss Eaton's Math Emporium, that'd be a lot to type across a little ticker when you're trying to get information out quickly. So they were given symbols. The New York Stock Exchange was 1, 2, or 3 letters. NASDAQ was always 4, but now some companies have transferred from the New York Stock Exchange to NASDAQ, and so NASDAQ allows 3. So if you had 3 on the New York Stock Exchange, you have the same 3 on the NASDAQ now. Examples of tickers: Visa is on the New York Stock Exchange, is the V. It's just V. And Coca-Cola is KO. Target is TGT. So they're just letters, and sometimes they're really, like, they make sense, and sometimes you look at them and you go, I don't know. You have to look them up, because they don't make sense. The next thing that shows on the ticker is the number of shares. And these are shares per transaction. Okay, so if I buy 200 shares of Target, my trade will show up on the stock market ticker because it's per transaction. Then they use abbreviations. K for 1,000, M for million, B for billion, and my piddly little 200 would just show up as a 200. Okay. The billion isn't seen very often. Usually it's thousands and millions that you see. And then you get the price per share. So not the total transaction, like not the total price of all 200 stocks that I just bought, but like the price per share that I paid. And that's preceded by an @ symbol. Preceded, whoops. Okay. However, some reporting systems don't use the @ symbol. They leave it out and there's just a blank. Most of them do put the @ symbol in there though. And then you have directional arrows. And I can't draw arrows upside down very well. Okay. Okay, this is the previous close. And then it's followed by the difference. Right here, this, not black, this is what the stock market ticker looks like. And if we want to read that, we see the V for Visa. 12K is the next bit of information. So that's 12,000 shares. Then we have @ 8737, so that tells me the price of each individual share. So the shares were 87.37 each. And then the next bit of information means it was up 12 cents from the previous day. Okay. So 12,000 shares of Visa sold for 87.37 each, and that was 12 cents more than yesterday. And I have no idea how much Target sells for. I just made this up, okay? What this would tell me is that 15 million shares of Target sold for $29.50 each. And it was $1.12 less than yesterday. So the down arrow tells me it was less than yesterday, and up arrow tells me it was more than yesterday. Math class you do. We're gonna, it would be nice though if you ever do buy a large, chunk of stock, you could look on the ticker and look for yours. That'd be kind of fun, right? Because every single stock transaction does show up on the ticker. That's why there's so much going on. All right, so we've got Coca-Cola, KO. Okay. 3,000 shares. 3,000. $57 a share, so at 57. And it would be down 25 cents. And you're talking about the total value of the whole trade. You have the number of shares that you bought, and you multiply that times the price per share. And that gives you your total value of your trade. So this is just extraneous information. We know that her price per share is $54.88. We don't need to know anything else about her transaction other than that she bought 15,000 shares. We're going to multiply that by her price per share. And the value of her trade was $823,200. You know that K is for thousands and M is for millions. So to find 2.5K, I take that 2.5 and I multiply it by 1,000. Or I move the decimal 3 places. And if I have 3.89 million, I take 3.89 and I multiply it by 1 million. Or you move the decimal 6 places. Okay. Just, you know, if you have to find the total volume of the trade, you can't multiply it by 3.9 M. You want to multiply by the actual number. Okay, so we want to create this ticker. We have 8,750 shares of Apple, and they're selling them for $190.30 on Friday, and on Thursday it was worth $187.83. So the first thing we need to find is the change. And that's $2.47. That's the change. How that would appear on the ticker, we've got the company. 8,750 shares is going to be 8.75K. Just like we would move the decimal 3 places this direction to go from the K to the number, we'd go backwards to go from the number to the K. Does that make sense? The price was $190.30, and that is up $2.47. And our total trade value, we have 8,750 shares times 190.30. So if we wanted to figure that out, $1,665.12. The grandkids did very well.